Every single morning, millions of traders open their laptops believing today could change their lives forever. Some are chasing financial freedom. Some are trying to escape the 9 to 5. And others are desperately trying to recover from painful losses that nearly destroyed their confidence. But the truth is, most day traders never make it. Not because they're unintelligent, not because the market is impossible, but because nobody taught them how the market really works. They buy too late, sell too early, trade emotionally, and slowly watch their accounts disappear trade after trade. Meanwhile, a small group of disciplined traders quietly extract money from the market every single week. They don't gamble, they don't chase hype, and they definitely don't rely on luck. They follow rules. They understand momentum. They understand risk. And most importantly, they understand psychology. Because day trading is not just a battle against the market. It's a battle against fear, greed, impatience, and your own emotions. In this video, you're going to learn what day trading really is, why most traders fail before ever becoming profitable, and the exact strategies professional traders use to identify high-probability opportunities in the market. We'll break down powerful concepts like VWAP trading, momentum pullbacks, risk management, trade discipline, and the mindset required to survive in one of the most competitive financial arenas in the world. Because the goal is not to gamble. The goal is consistency. The goal is freedom. And the goal is building a skill that can potentially change your financial future forever. So if you're serious about learning how day trading really works, and what it truly takes to trade for a living, then stay with me until the end. Because this might be the most important trading video you ever watch. So, what exactly is day trading? At its core, day trading is the process of buying and selling financial instruments within the same trading day. That could mean stocks, options, forex, cryptocurrency, or futures contracts. Unlike long-term investors, who may hold positions for months or even years, day traders enter and exit trades quickly, sometimes within minutes, sometimes within seconds, and in many cases, all positions are closed before the market closes for the day. The goal is simple: capture short-term price movements and turn those movements into consistent profits. Now, on the surface, that sounds easy. Buy low, sell high, take profits, repeat. But in reality, day trading is one of the most psychologically demanding skills in the financial world. Because the market moves fast, prices can explode upward within seconds, or collapse violently without warning. One moment, you're up hundreds of dollars, and minutes later, you're watching profits disappear right in front of your eyes. That's why professional traders don't approach the market emotionally. They approach it strategically. Most successful day traders are not predicting the future. They're reacting to probability. They look for specific patterns, specific setups, specific signals. That historically increased the odds of a profitable trade. And one important thing beginners often misunderstand is this: professional trading is not gambling. Gambling relies on hope. Professional trading relies on risk management, discipline, data, and execution. A gambler risks everything trying to hit one lucky trade. A professional trader protects capital first and understands that survival is the foundation of long-term success. Because in trading, your first job is not making money. Your first job is staying in the game long enough to develop skill and consistency. Now, there are many different styles of day trading. Some traders focus on momentum trading, where they chase stocks moving aggressively with strong volume. Others specialize in reversal trading, trying to catch stocks bouncing from oversold conditions. Some traders use a VWAP strategies, looking for institutional support and high-probability entries around key price levels. And others focus on news catalysts, earnings reports, economic releases, or breaking headlines that create explosive volatility. But no matter the strategy, every successful trader eventually learns the same lesson. The market rewards discipline and punishes emotional decision-making. Fear causes traders to sell too early. Greed causes traders to overstay winning positions. Revenge trading destroys accounts after losses. And impatience leads traders into low-quality setups they should never have taken in the first place. That's why consistency in trading is less about finding a magical indicator and more about developing repeatable habits. Professional traders think in probabilities, not certainties. They know losses are part of the business. Even the best traders in the world lose trades regularly. The difference is, they manage risk so effectively that their winners outweigh their losers over time. And that's what separates professionals from amateurs. Not perfection, but consistency. Because day trading is not a get-rich-quick scheme. It's a performance skill, just like becoming a professional athlete, a surgeon, or a pilot. It requires education, practice, patience, and emotional control under pressure. And the traders who truly succeed understand something most beginners never realize. The real edge in trading is not the strategy alone. The real edge is the trader behind the strategy. So why do most traders fail? Why do so many people enter the market filled with excitement and hope, only to quit months later frustrated, broke, and emotionally exhausted? Because the truth is, the market exposes human weakness faster than almost anything else in life. Most beginners enter trading believing success comes from finding the perfect indicator, the perfect strategy, or the perfect stock. But that's not what destroys most traders. What destroys them is psychology. The market is designed to trigger emotion, fear, greed, hope, panic, overconfidence, impatience. And if a trader cannot control those emotions, the market will punish them over and over again. One of the biggest reasons traders fail is overtrading. They feel the need to constantly be in a position. They believe more trades equal more money. So they force setups that simply are not there. Instead of waiting patiently for high-probability opportunities, they chase random price movement out of boredom and impatience. And that's when losses begin to stack up. Another major reason traders fail is poor risk management. Many beginners focus only on profits. They dream about turning a small account into millions overnight. But professional traders think differently. Professionals focus on protecting capital first, because they understand a simple truth. If you lose all your money, you can no longer trade. Yet beginners often risk huge portions of their account on a single trade. One emotional mistake, one unexpected news event, one market reversal, and suddenly their account is destroyed. That's why disciplined traders survive while emotional traders disappear. Then there's revenge trading, one of the most dangerous habits in trading. A trader takes a loss, becomes angry, and immediately jumps back into the market trying to win the money back. Now the decisions are no longer logical. They become emotional. Trade size increases, rules disappear, and losses accelerate. The market can sense desperation, and desperation almost always leads to bad decisions. Another reason most traders fail is unrealistic expectations. Social media has convinced many people that trading is easy. They see screenshots of massive profits, luxury lifestyles, and flashy trading influencers claiming they turned a few $100s into fortunes overnight. But what they don't show you are the losses, the emotional pressure, the years of failure, the blown accounts, the discipline required to become consistently profitable. Trading is not instant wealth. It's a skill developed through repetition, experience, and emotional control. And just like any professional skill, mastery takes time. Another hidden reason traders fail is the inability to adapt. Markets constantly change. What works perfectly in one market environment may stop working completely in another. Strong bull markets behave differently from bear markets. Low volatility markets behave differently from highly volatile markets. Professional traders understand this. They stay flexible. They evolve with the market. But beginners often become emotionally attached to one idea, one bias, or one strategy. And the market punishes rigidity. Then there's the issue almost nobody talks about: lack of discipline. Because trading freedom sounds exciting, until you realize freedom without discipline becomes dangerous. No boss is standing over your shoulder. Nobody is stopping you from breaking your rules. Nobody is forcing you to respect risk. And that's why many traders sabotage themselves. They move stop losses. They average down losing positions. They ignore their trading plans. And eventually, emotions take complete control. But perhaps the biggest reason most traders fail is they quit too early. They expect immediate success in one of the most competitive industries in the world. And when results don't come quickly, they give up. Meanwhile, the traders who eventually succeed are usually the ones who survive long enough to learn from their mistakes. Because every successful trader has lost money. Every successful trader has struggled emotionally. Every successful trader has doubted themselves at some point. The difference is, they kept learning, they kept adapting, and they slowly transformed from emotional traders into disciplined professionals. Because in the end, the market rewards patience, punishes recklessness, and exposes anyone who refuses to respect risk. Now let's talk about one of the most powerful tools used by professional intraday traders: VWAP, the volume-weighted average price. At first glance, VWAP may look like just another line on a chart, but in reality, it's one of the most important institutional indicators in modern trading. Because VWAP reveals where the average trader, weighted by volume, has transacted throughout the trading day. And that matters for one very important reason. Institutional money watches VWAP closely. Hedge funds, banks, algorithms, and professional traders use VWAP to determine whether a stock is trading at a strong value or becoming overextended. That's why price behavior around VWAP can become extremely important. Now here's the basic idea behind VWAP trading. When price remains above VWAP, it often signals strength. Buyers are in control. Momentum remains bullish, and institutions may continue supporting higher prices. But when price trades below VWAP, that often signals weakness. Sellers dominate the market. Momentum shifts bearish, and rallies may struggle to hold. Think of VWAP as a battlefield line between buyers and sellers. A stock holding above VWAP shows strength. A stock repeatedly rejecting below VWAP shows weakness. And professional traders use this information to make high-probability decisions. One of the most common setups traders look for is the VWAP bounce. This happens when a strong stock pulls back toward VWAP, finds support, and then aggressively resumes higher. Why is this important? Because strong trending stocks often respect VWAP during healthy momentum moves. Institutions may use pullbacks toward VWAP as opportunities to add positions. And retail traders watching the move often jump back in once the stock begins bouncing again. This creates momentum continuation. Now imagine a stock exploding higher after major news, strong earnings, or unusually high volume. The stock becomes overextended, then slowly pulls back toward VWAP. Weak hands begin selling, late buyers panic, but instead of collapsing, the stock stabilizes around VWAP. Volume starts returning, buyers step back in, and suddenly, momentum resumes. That's the VWAP bounce. And when executed correctly, it can become one of the highest probability continuation setups in day trading. But here's something most beginners misunderstand. Not every touch of VWAP is a buying opportunity. Context matters. A weak stock under heavy selling pressure can slice straight through VWAP without bouncing at all. That's why professional traders combine VWAP with other important factors like relative volume, news catalysts, market sentiment, price action, trend structure, and momentum strength, because trading is about stacking probabilities, not blindly reacting to one indicator. Another important VWAP concept is the VWAP reclaim. This happens when a stock initially trades below VWAP, then suddenly reclaims it and begins holding above it. This can signal a major shift in momentum. Why? Because trapped short sellers may begin covering positions, while buyers regain confidence. And when that happens, momentum can accelerate quickly. Many powerful intraday reversals begin with a VWAP reclaim. Now let's talk about one of the biggest mistakes new VWAP traders make: chasing extended moves. A stock may already be far above VWAP after a massive breakout. Excitement builds. FOMO kicks in, and traders enter too late, right before the pullback begins. Professional traders understand patience. They wait for structure. They wait for confirmation. They wait for controlled pullbacks instead of emotional entries, because discipline matters more than excitement. Another key part of VWAP trading is understanding volume. VWAP setups become much more powerful when volume increases during the bounce or reclaim. Why? Because volume confirms participation. A move without volume can easily fail, but strong volume often signals institutional activity and genuine momentum. And remember, VWAP is not magic. No indicator works perfectly. There will always be failed setups, false breakouts, and unpredictable market conditions. That's why risk management remains critical. Professional traders never assume certainty. They manage risk carefully on every trade, because one bad trade should never destroy weeks of progress. And that mindset is what separates disciplined traders from emotional gamblers. VWAP is not simply a line on a chart. It's a framework for understanding market behavior, institutional positioning, momentum, and probability. And once traders truly understand how price reacts around VWAP, the market begins making a lot more sense. Now let's talk about one of the most explosive setups in day trading: the momentum pullback strategy. This is the strategy many professional momentum traders use to capture powerful continuation moves after an aggressive breakout. Because in the market, strong stocks rarely move in a straight line forever. Even the strongest momentum moves eventually pause, pull back, and shake out weak traders before continuing higher. And that temporary pullback can create incredible trading opportunities. The momentum pullback strategy is built around one core idea. Instead of chasing a stock after a massive spike, You wait patiently for the pullback. You wait for weakness to slow down. You wait for buyers to step back in, and then you enter as momentum begins continuing in the original direction. This approach is powerful because it allows traders to enter with better timing, better risk control, and higher probability confirmation. Now, imagine a stock suddenly exploding higher after major news. Maybe it released strong earnings. Maybe it received FDA approval. Maybe the company announced a major partnership. Suddenly, volume floods into the stock. Price surges aggressively. Social media explodes with excitement. Retail traders begin chasing, and the stock becomes one of the hottest movers in the market. But here's what professional traders understand. Chasing vertical spikes is dangerous because emotional buying often happens near temporary tops. And many beginners lose money by entering too late after the initial breakout already becomes extended. Professional traders stay patient. They wait for the pullback. Now here's where the strategy becomes interesting. A healthy pullback does not mean the trend is broken. In fact, strong momentum stocks often pull back in a controlled and orderly way before continuing higher. Volume may decrease during the pullback. Selling pressure slows down. Price begins consolidating. And stronger buyers quietly prepare for the next move. This is where experienced traders begin paying close attention. One of the biggest clues traders look for is structure. Does the stock hold above key support levels? Does it respect VWAP? Does it form higher lows? Does selling pressure weaken during the pullback? Because these signals often reveal whether momentum remains intact. Now, one important thing separates strong momentum pullbacks from weak setups: the quality of the original impulse move. Professional traders love stocks that move aggressively and decisively. Strong momentum often begins with explosive candles, high relative volume, and fast price expansion. That initial surge signals urgency. It signals institutional participation. It signals strong demand. And the stronger the initial move, the more attention the stock attracts. Now, after the pullback begins, professional traders wait for confirmation before entering. They don't blindly buy every dip. They wait for buyers to regain control. This confirmation may appear as a strong bullish candle, a breakout above consolidation, a reclaim of VWAP, increasing volume, or buyers aggressively defending support levels. And when momentum resumes, the continuation move can happen extremely fast. That's why patience becomes critical. Many beginners enter too early during pullbacks. They try catching the exact bottom. But professionals understand something important. Confirmation reduces risk. And in trading, reducing unnecessary risk is more important than predicting exact bottoms. Now, let's discuss one of the most dangerous mistakes momentum traders make: confusing weak stocks with temporary pullbacks. A true momentum pullback still shows strength underneath the surface, but weak stocks often show heavy selling, weak bounces, poor volume, repeated failures near resistance, and loss of momentum. Professional traders avoid forcing trades when momentum clearly weakens, because not every stock deserves attention. Another critical factor in momentum trading is timing. Momentum setups often work best during periods of high volatility and strong market participation, especially near the market open. Why? Because volume is highest during the opening session. Emotions run high. News catalysts impact the market rapidly, and momentum can accelerate quickly. That's why many day traders focus heavily on the first 1 to 2 hours after the opening bell. Now let's talk about psychology. Momentum trading sounds exciting, but emotionally, it can be extremely difficult because fear constantly enters the trader's mind. Fear of missing out, fear of entering too late, fear of pullbacks, fear of losses, and that emotional pressure causes many traders to make impulsive decisions. But disciplined traders remain calm. They follow structure, they wait for quality setups, and they understand that one great trade is better than forcing 10 mediocre trades. Because consistency is built through selective execution, not constant activity. And perhaps the most important lesson in momentum trading is this: you do not need to catch every move. You only need a few high-quality opportunities executed properly over time. That mindset changes everything, because once traders stop chasing every stock and start focusing on disciplined execution, the market becomes far less emotional and far more strategic. Now let's talk about the difference between traders who survive and traders who disappear. Risk management, because in trading, making money is important, but protecting your capital is absolutely critical. Most beginners enter the market obsessed with profits. They think constantly about how much money they can make, how quickly they can grow a small account, how soon they can quit their jobs. But professional traders think differently. Professionals focus first on one thing: how much they could lose. Because successful trading is not built on one lucky trade. It's built on survival, and survival depends entirely on risk management. Here's the reality most beginners learn too late. Even the best trading strategy in the world will eventually produce losing trades. No setup works 100% of the time. Not VWAP, not momentum pullbacks, not price action. Nothing. Losses are part of the business. And the traders who survive understand how to control those losses before they become catastrophic. One of the biggest mistakes traders make is risking too much on a single trade. They become emotionally attached to one setup. They feel overly confident. Or they desperately try recovering previous losses quickly, so they increase position size beyond what their account can safely handle. And one bad move suddenly wipes out weeks, or even months, of progress. That's why professional traders think in percentages, not emotions. Many disciplined traders risk only a small percentage of their account per trade, because they understand something very important. A trader who protects capital always has another opportunity tomorrow. But a trader who blows up their account is finished. Another critical concept in risk management is the stop loss. Beginners often hate stop losses because taking losses feels painful, so they move their stop farther away, or remove it completely, hoping the market will recover. And sometimes it does, but eventually, one uncontrolled trade turns into a disaster. Professional traders accept losses quickly, not emotionally, but strategically, because small losses are manageable. Large losses are destructive, and the market punishes traders who refuse to respect risk. Now let's talk about reward versus risk. Professional traders don't just ask, "How much can I make?" They ask, "Is this trade worth the risk I'm taking?" For example, risking $200 to potentially make $20 usually makes little sense. But risking $100 to potentially make $300, that creates favorable mathematics over time. This is called risk-to-reward ratio. And over hundreds of trades, good risk-to-reward management can completely transform a trader's long-term performance. Even traders with average win rates can become profitable if their risk management remains strong. Another major part of risk management is emotional discipline, because sometimes the greatest risk is not the market itself, it's the trader. Fear causes traders to exit winning trades too early. Greed causes traders to overstay positions. Revenge trading causes traders to ignore rules entirely after losses. And overconfidence causes traders to become careless during winning streaks. That's why professional traders create rules before entering trades. Rules for entries, rules for exits, rules for stop losses, rules for position sizing, and most importantly, rules designed to protect them from emotional decision-making. Now here's something many beginners don't understand. Professional trading is often boring. Why? Because disciplined traders avoid unnecessary action. They wait patiently. They protect capital. They take only high-quality setups. And they understand that consistency matters far more than excitement. Because one disciplined trader following proper risk management can survive for years, while reckless traders may disappear after only a few emotional trades. And in the end, risk management is what allows traders to stay in the game long enough to become consistently profitable. Because trading success is not about avoiding losses completely. It's about controlling losses so effectively that your winners can steadily outweigh them over time. And that is the foundation of long-term trading survival. Now, let's talk about the part of trading most beginners completely underestimate: psychology. Because the truth is, trading is far less about charts and far more about controlling yourself under pressure. Most traders believe success comes from finding the perfect strategy, but eventually they discover something shocking. Two traders can use the exact same setup, the exact same chart, the exact same indicator, and still produce completely different results. Why? Because psychology changes execution, and execution determines outcomes. The market constantly tests emotional control. Fear, greed, impatience, overconfidence, frustration. All of these emotions influence decision-making. And if traders cannot control those emotions, their strategy eventually falls apart. One of the biggest psychological enemies in trading is fear. Fear causes traders to hesitate on valid setups. They second-guess themselves. They miss opportunities, or they exit winning trades too early because they're afraid profits will disappear. Then, ironically, the stock continues moving exactly as planned after they already sold. Over time, this destroys confidence. But greed can be just as dangerous. Greed convinces traders to overstay winning positions. Instead of taking planned profits, they become emotionally attached to the trade. They want more. And sometimes a winning trade suddenly reverses, turning profits into losses. Then there's revenge trading, one of the fastest ways to destroy an account emotionally and financially. After taking a loss, many traders feel the overwhelming need to immediately recover the money. So they enter random trades impulsively. Position size increases. Patience disappears, discipline collapses, and losses become even worse. Professional traders understand something beginners often ignore. The market does not care about your emotions. It does not care about your frustration, your fear, your hopes, or your opinions. The market simply responds to supply, demand, liquidity, and participation. And traders who become emotionally reactive usually lose consistency. That's why discipline becomes everything. Discipline means following your plan, even when emotions tell you not to. It means respecting stop losses, waiting patiently for setups, avoiding low-quality trades, and refusing to chase emotional impulses. Now here's something many successful traders eventually realize. Trading should not feel exciting. In fact, the more emotional excitement a trader feels, the more dangerous the situation often becomes. Professional traders seek calm execution, routine, structure, consistency, because discipline creates stability, and stability creates long-term survival. Another major psychological challenge is dealing with losses. Every trader loses. Even elite hedge funds lose. Even professional institutional traders lose. Losses are unavoidable, but emotionally immature traders often take losses personally. They begin doubting themselves, doubting their strategy, or trying to completely reinvent everything after only a few bad trades. Professional traders think differently. They understand that trading is a probability game. One trade means very little. What matters is performance over many trades executed consistently over time. That mindset changes everything. Because once traders stop obsessing over individual wins and losses and start focusing on disciplined execution, their emotional stability improves dramatically. Now let's talk about patience, one of the rarest skills in trading. The market rewards patience constantly. But human psychology naturally wants action. Traders feel pressure to trade every day, every hour, every market move. But experienced traders understand something important. No trade is also a position. Sometimes the best decision is waiting. Waiting for confirmation. Waiting for quality. Waiting for the market to align with your strategy. Because forcing trades out of boredom usually leads to poor execution. And finally, there's confidence. Not arrogance, not ego, but quiet confidence built through preparation and repetition. Professional traders trust their process, they trust their rules, and they understand that consistency comes from disciplined execution, not emotional reactions. Because at the end of the day, the market is not simply testing your strategy. It's testing your mindset, your discipline, your emotional control, and your ability to remain calm while everyone else panics. And the traders who eventually succeed are usually the ones who master themselves before trying to master the market. So after everything we've covered, what's the real truth about day trading? It's not easy. It's not instant wealth. And it's definitely not a shortcut to success. Day trading is a skill, a performance skill built through education, experience, discipline, and emotional control. The market will test your patience. It will test your confidence. And at times, it will test your ability to stay calm under pressure. But for traders willing to approach the market professionally, willing to manage risk, willing to control emotions, and willing to stay disciplined even during difficult periods, trading can become far more than just a hobby. It can become a life-changing skill. Because the goal is not gambling. The goal is consistency. The goal is freedom. The goal is building a system and mindset capable of surviving long-term in the market. And remember, professional traders are not trying to win every trade. They simply execute high-probability setups consistently over time while protecting their capital. That's the real edge, not perfection, but discipline. So whether you're learning VWAP, momentum pullbacks, risk management, or trading psychology, focus on mastering the process instead of chasing quick money. Because consistency is built slowly, one disciplined trade at a time. And if you found value in this video, make sure to subscribe for more high-probability trading strategies, smart money concepts, and professional trading education. And if you're serious about becoming a consistently profitable trader, check the links below for additional resources, books, and trading tools designed to help accelerate your journey. Thanks for watching, and I'll see you in the next video.